Greetings, Jonathan Camarda, Chief Investment Officer. Hopefully you're all doing well. Another Whiplash Friday. So I think we've had enough this year to keep a chiropractor's office busy for the next probably 5 years, or at least a presidential term. But all levity aside, today we'll kind of start twofold with the jobs numbers, number one, where we were looking at essentially a lighter number than last month, which was basically tipped off. It came in the low 300s off of the high mid 500s last month. Jobless claims and as such in the low single digits. The job market, there's been hiring. It's been going up. However, there is some softening showing, which may actually transition the leverage for those out there still in the workforce from the employees to the employers for whatever that's worth, and whoever that may mean something to. Just letting you know that seesaw is flipping around a little bit as far as where the leverage is, as a lot of companies are actually laying off or at least slowing hiring. So with that being said, you'll notice today would be the 2nd of September, the market started with a nice little march to the upside, and now it looks like we have mostly red. Not quite like Fed red last week, right? But red on the screen, after reality set in what this means. So let's talk about what it means in terms of what the Fed said last week, and even this week as some of the members came out, like what were those two old guys in the, remember the Muppets and the Bannister? I can't remember their names, but it's what the Fed kind of reminds me of, probably you as well. You'd rather them just sit in their seats and read from the hymn books very quietly, right? That's not the case anymore. So what the Fed said last week clearly is that regardless of some of this extraneous data, including jobs data, that they were going to remain on a path of 2% as far as their inflation goals. In fact, the rate, I think Mester, if I have her name correct, came out this week and said 4% is the Fed's number that they're looking to get the Fed, their rate up to, not to be confused with where they want inflation at 2%. Okay, so they want inflation at 2. They're looking about getting the rates up to 4%. Okay, so the jobs numbers that came out today were a little tepid. Showed a little loosening, not as hot as last month, and the market went up. Right, but once again, this has been the year that where every rally, comes to die. Right, especially on Fridays. Goodbye Fridays, because what you saw as the rally started, and again, whether it was amateur, money movement or what have you, no one could really define it, especially intraday. The large institutional money, just trust me on this, is on the sidelines and watching very carefully what the Fed said last week and listening and realizing that this is definitely a grisly maze, pardon the pun, and where we already are in the midst of a bear market. And in every bear market we can go back and remember, every one, the Fed has come to the rescue. Helicopter Ben, you had Greenspan, we obviously had Powell a few years ago with turn costs. That's not the case right now. So being cognizant of that, you saw again the market retreat and give back all those gains and then fade into a blood red tide here. Now when we look at the technicals, it's even more damning in the short term. And that's why many of your strategies, we've been preparing for this the last few weeks. We'll get to that. But you'll notice last week, you might not notice, but we probably told you about it. And, maybe you turn this off at some point, and who can blame you after a while, especially with all the bad news. But the technicals, which are essentially the chessboards, if you will, for the institutional money, right? The smart money, the money that knows what, when, where, and why, how, when we're all just saying, huh? That's why you look at the charts, folks. And the 200-day moving average was a hard line of resistance last week, just concurrently with the Fed speech. And so the market, which has been, a lot of ugly red over the last week on your screens there, into this week, into where the market not only got resisted at the 200-day moving average, but fell below its 50-day moving average. Okay, that is very serious on the technical front. Now today when we had that little rally to the upside, the market hit the 50-day, just like last week it was just at the 200, right? So think when you're taking a trip, right, past one exit, right? Us guys are always guilty of this, right? And the next exit, before we had GPSs and on our phones and everything, right? No, stop and never ask for directions, right, gentlemen? So we passed another exit, the 50-day moving average. Tried to turn back around, couldn't. We got resisted. Pardon the metaphor, but summer vacation's over. Maybe that makes more sense than the technicals. A lot of clients tell me anyway. We got resisted at that 50-day moving average today on top of this jobs number, which was somewhat taken almost like as a ruse when we had the upside, and now the red settles in that you're seeing behind me there. So what does this mean? Well, for most of your strategies, we were already prepared for this, right? The last few weeks, we've been getting defensive. And if you notice, going into Fed Day, and then even after Fed Day, slight adjustments in all strategies. Nothing too noteworthy except taking more risk off the table of the little risk that we still had across global macro, tactical macro momentum, sector momentum, Velocity Raptor. One exception would be opportunistic growth in income, which is more of a fundamental strategy. That's the one we see some of those dividend-paying stocks and such, where that's a little bit more longer moving, although it will adjust during major movements, and did do some tax loss harvesting earlier this year. However, most of the other tactical strategies that are generally in IRAs, right, where there's no taxes and virtually no commissions, always exceptions, but not really that many we see these days. Those strategies were already prepared for this as we've come into September with our head on a swivel, like a Navy SEAL, right? We enter the room, we're just looking for the exit, right? We're not looking for any extended combat. In other words, we don't want to, metaphorically speaking, right, you've heard the term, combat, fight the Fed. And at this point, that's where we are. Now, on top of that, after a pretty macabre August, after a jubilant July summer party in the market, September is generally the worst, not generally, it is the worst month of the year historically for the market. 56% of the time, it's down. So there are some contrarians out there that think we're going to get an unexpected bounce. Well, if we do, we'll grab the tennis racket and take advantage. But at this point, we are going to just, metaphorically speaking, sit on the pine, if you will, and watch and make sure. You have to recapture that 50-day moving average first. Let us do all the heavy lifting. You don't have to worry about any of that. But some of the folks out there that do keep track at a more copious level, that's what we're looking at as a base camp. So that's all. You probably had enough of me. The only good news, I guess, to wrap up this week is we do have football starting for all your NFL and college fans. I guess college this week, NFL in a week. So at least your weekends will be somewhat of a respite beyond your usual golf and baseball. All right, so appreciate your time, your patience, and most importantly, your trust. Stay frosty out there. And until next time, Jonathan Camarda.